Part 2. Managers and stockholders. Those stockholders possess legal rights over management, practically they're impotent. Stockholders follow the management irrespective of how it performs. Though management is usually decent, there are many cases of dishonest and incompetent management. Stockholders must get serious about using their rights as owners. To be specific, they must do the following. Management efficiency. Management is very crucial in the performance of stock investments. But investors don't have much interest in checking management quality. Even less so in removing incompetent managers. Stockholders should develop an interest in the efficiency of the management. They must monitor the management quality with objectivity. If the return to shareholders falls even though the market booms, then they must seek justifications. The information necessary for such an analysis is available. Shareholders might think those chosen directors which defend their interests. But they should remember that managers select directors. Many biases take place and directors tend to fall in management's favor. Outside stockholders, shareholders external to the company are outside stockholders. They aren't involved in managing or controlling the firm. Insiders usually manage firms to serve their interest. Many times, even at the cost of outside stockholders. Such bias is most visible in holding companies. In such firms, the stocks are decidedly less valued in comparison to the asset values behind them. Insiders can remove this bias by breaking the holding firm, though outsiders will profit. But managers rarely do this on their own. Hence, stockholders of holding companies continue agreeing with the management that doesn't act for their interests. Shareholders have both responsibilities and rights of control. They must use them wisely. Quotes from the book. The genuine investor in common stocks does not need a great equipment of brains and knowledge, but he does need some unusual qualities of character. Investment is most intelligent when it is most businesslike. Nothing in finance is more fatuous and harmful than the firmly established attitude of common stock investors and their Wall Street advisors regarding questions of corporate management. That attitude is summed up in the phrase, if you don't like the management, sell your stocks. Good managements produce a good average market price. And bad managements produce bad market prices. Only in the exceptional case, where the integrity and competence of the advisors have been thoroughly demonstrated, should the investor act upon the advice of others without understanding and approving the decision made. The intelligent investor needs an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Some of these issues may prove excellent buys a few years later, when nobody wants them and they can be had at a small fraction of their true worth. A prime test of the competent analyst is his power to distinguish between important and unimportant facts and figures in a given situation. This matter of choosing the best stocks is at bottom a highly controversial one. Our advice to the defensive investor is that he let it alone. Insiders never suffer loss from an unduly low market price, which it is in their power to correct. If by any chance they should want to sell, they can and will always correct the situation first. It is amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they have gained success in their own undertakings. Thoughts on the intelligent investor. If you are an investor and looking for some great help regarding making investments, then this book is a must-read. Benjamin Graham has compiled so much informative and useful information with regards to investment in this book. There are fundamentals of investment, which are explained in detail by the author. It is important for every investor to understand what are some of the basics of investment, and this book is a great one to understand that. It explains that there are two major types of investors, one is called defensive, and the other is called enterprising. The defensive investors are the ones who don't believe in making less possible mistakes in their investment decisions and ensure that their money is saved for better investment opportunities. On the other hand, enterprising investors are aggressive in approaches, who want to take brave decisions, like they may buy stocks when the market is down. It is true that today's financial markets are different from the time when this book was published. But still, the author has explained various basic concepts, which can be crucial in making investment decisions. The one concept which I liked in this book is about speculations. The author has tried to explain that making mere speculations is not good. And speculations cannot be related to investing, as most of the times, speculations get failed. There is no concrete evidence to suggest that market forecasts, as well as timing, will work in favor of the investors. So, one should completely avoid making false speculations. The details about value investing are also fruitful for investors. The famous people like Warren Buffett has learned about value investing in this book, so it shows that there is a lot to learn from the material of the book. Everyone who aspires to be an investor or an existing investor, this book is going to be a great tool for them to make investment decisions with less possible mistakes.